Navigating the labyrinth of tax laws and regulations can be daunting, but leveraging family-related tax strategies offers a powerful means to reduce your tax liability and maximize your financial efficiency. The ultimate guide to saving taxes through family focuses on 10 key strategies that can provide substantial tax benefits and support long-term financial planning. Families can more effectively manage their tax burden, create additional financial flexibility, and build wealth more efficiently by comprehending and implementing these methods. Each strategy is essential for optimizing your financial situation, from claiming dependents and utilizing education-related tax credits to maximizing the potential of family business structures and estate planning tools. Tax-saving opportunities are not limited to the reduction of your annual tax liability. They also incorporate more comprehensive financial planning components, including retirement savings, investment strategies, and intergenerational wealth transfer. This video explores the practical steps and considerations of each strategy, assisting you in comprehending how to incorporate these strategies into your comprehensive financial plan. Regardless of whether you are a parent seeking to capitalize on education credits, a business owner interested in hiring family members, or an individual who is thinking about future generations, these strategies can have a substantial impact. By effectively implementing these tax-saving strategies, you not only decrease your current tax liability, but also improve the financial security of your family. By remaining informed about these opportunities and adapting to changes in tax laws, you can ensure that you take advantage of the available benefits and secure a more prosperous financial future for your family. 1. The claiming of dependents. Claiming dependents is a simple yet highly effective method of reducing your tax liability. If you have children or other qualifying dependents, you may be eligible for a variety of tax benefits by including them on your tax return. You may be eligible for deductions or credits that substantially reduce your taxable income for each eligible dependent. For instance, the child tax credit has the potential to reduce your tax liability by up to $2,000 per qualifying child under the age of 17. Furthermore, the dependent care credit, which assists in the reduction of childcare expenses, and the Earned Income Tax Credit (EITC), which can generate additional savings contingent upon family size and income, are also available. Advice: stay informed about the most recent eligibility requirements and tax credit limits, as they are subject to change on an annual basis. Maximizing your savings and ensuring that you are fully utilizing the available benefits can be achieved through the submission of accurate and timely claims. 2. Application of the Child and Dependent Care Credit. The Child and Dependent Care Credit is a valuable tax break for families that pay for child care or care for dependents while working or pursuing employment. This credit reimburses a portion of qualifying care expenses, which can significantly reduce your taxable income. The credit you are eligible to claim is contingent upon the number of children or dependents receiving care and your income. Ensure that you maintain meticulous documents of all care-related expenses in order to optimize your benefits. This encompasses the preservation of receipts, provider information, and the dates of care. Accurate documentation of these expenses can optimize the credit and reduce your tax liability. Advice: it is important to conduct regular reviews of the eligibility criteria and percentage rates for the credit, as they may fluctuate in response to legislative changes in income. A comprehensive comprehension of current regulations and appropriate documentation will enable you to obtain the highest possible credit limit. 3. Contributing to a family health savings account (HSAs). Health savings accounts (HSAs) are a potent instrument for tax savings and medical expense planning due to their triple tax advantage. Contributions to an HSA are tax deductible, which reduces your taxable income. Furthermore, withdrawals for qualified medical expenses are tax-free, and the funds in an HSA grow tax-free. This renders HSAs especially advantageous for individuals who have health plans with high deductibles. HSAs provide even more advantages for families. In comparison to individual coverage, a higher annual contribution is permitted with family coverage under an HSA-compatible plan. This can further decrease your taxable income and improve your capacity to save for future medical expenses. Advice: take full advantage of the higher limits for family coverage by regularly reviewing and optimizing your HSA contributions. Consistent contributions and appropriate planning can result in substantial tax savings and improved healthcare expense management. 4. Maximizing the benefits of education tax credits. The American Opportunity Credit and the Lifetime Learning Credit are examples of education tax credits that provide significant savings for individuals who are pursuing higher education. The American Opportunity Credit offers up to $2,500 per eligible student for the first 4 years of college, which covers a substantial portion of tuition and associated expenses. In the interim, the Lifetime Learning Credit provides a maximum of $2,000 per tax return for any level of post-secondary education, including graduate courses. These credits have the potential to substantially reduce your tax liability, thereby rendering education more affordable. In order to qualify, it is imperative that your educational expenses are in accordance with the necessary criteria and that you or your dependents meet them. Advice: maintain meticulous records of all tuition and related expenses, including receipts and proof of payment. To guarantee a seamless claims process, it is essential to provide accurate documentation in order to claim these valuable credits and optimize your tax savings. 5. Hiring family members. Employing family members can serve as an effective tax-saving strategy for business owners. Your business's taxable income is diminished by the deduction of wages paid to family members as business expenses. Furthermore, your children's income may be subject to reduced tax rates or exempt from tax altogether if you employ them, contingent upon their total earnings. Advice: to prevent potential disputes with tax authorities, guarantee that the wages paid are equitable for the work completed and that they adhere to all applicable labor laws. 6. Transferring assets to family members. The annual gift tax exclusion enables you to transfer a specific quantity of money or assets to family members each year without being subject to gift tax. The exclusion for 2024 is $17,000 per recipient. Gifting assets can decrease the size of your estate, potentially reducing your future estate tax liability. This approach is advantageous for the purpose of transferring wealth and providing for family members without any imminent tax implications. Advice: maintain comprehensive records of all gifts and verify that they are within the exclusionary limits to prevent unintended tax repercussions. 7. Application of the family medical expense deduction. The IRS permits the deduction of unreimbursed medical expenses that exceed 7.5% of your adjusted gross income AGI, which should be substantial. Ensure that you maintain comprehensive records and consider itemizing deductions to optimize your savings if you or your dependents have substantial medical expenses. Advice: ensure that you claim all eligible deductions by tracking all medical expenses, including prescriptions, treatments, and travel related to medical care. 8. Optimizing retirement contributions. Your taxable income can be reduced by contributing to retirement accounts, such as a 401k or IRA. These accounts can be particularly advantageous for families. Employer-sponsored 401k plans provide pre-tax contributions that reduce your taxable income for the year, and contributions to a traditional IRA are tax-deductible. Advice: families should consider contributing to spousal IRAs if one partner is not employed, and individuals should maximize their contributions to both employer-sponsored and individual retirement accounts. 9. Receiving the adoption credit. The adoption credit may be available to you if you have adopted a child. This credit serves to mitigate the expenses associated with adopting a child, such as court fees, legal fees, and adoption fees. The credit is contingent upon income restrictions. Therefore, it is imperative that you satisfy the requirements and retain all pertinent documentation. Advice: monitor all expenses associated with adoption and seek the advice of a tax professional to guarantee that you receive the utmost credit permitted. 10. The utilization of a family trust. The establishment of a family trust can offer a variety of tax benefits, such as the capacity to distribute and manage assets while reducing estate taxes. Additionally, a trust can facilitate charitable donations and guarantee that your estate is distributed in accordance with your preferences. Advice: collaborate with a financial advisor or estate planner to establish a trust that is consistent with your financial objectives and offers the greatest tax advantages. In conclusion, navigating the intricacies of tax savings through family-related strategies can provide substantial financial advantages and improve your overall financial well-being. Families can optimize their financial outcomes and substantially reduce their tax burden by utilizing the diverse credits, deductions, and planning opportunities that are available. From strategically employing family members and establishing trusts to claiming dependents and utilizing education tax credits, each strategy is essential for minimizing taxes and accumulating long-term wealth. Careful planning and frequently professional guidance are necessary to effectively comprehend and implement these strategies. The objective is to establish a financially secure foundation that aligns with the objectives and requirements of your family, whether that entails optimizing retirement account contributions, utilizing family trusts for estate planning, or utilizing medical expense deductions. It is imperative to remain informed and adjust your strategies as tax laws and benefits continue to evolve. Consistently examining your tax situation and consulting with a tax professional can guarantee that you are complying with current regulations and capitalizing on available opportunities. By taking a proactive approach to managing your tax strategy, you can improve the financial stability of your family and strive for a more secure and prosperous future. Let us know in the comments what you think about the ultimate guide to saving taxes through family, and don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.